What does the interest rate increase mean for you? Interest rates are increasing. The Federal Reserve, the central bank, is increasing rates, so we all will see our borrowing costs potentially rise. Here are some ways that this could affect you and your monthly expenses. So what exactly is happening? The federal funds interest rate is the rate at which banks lend and borrow to each other overnight. It's set by the central bank. The Fed's actions have an impact on the savings and borrowing rates consumers see every day, even though it isn't the rate they pay. When the Fed raises its benchmark rate, rates on savings accounts, credit cards, and other types of loans change. Changes in the benchmark rate of Federal Reserve have ripple effects on all aspects of credit, from student loans to home mortgages to credit cards. So why are interest rates rising? The Federal Reserve is trying to raise rates to try to control inflation, which has reached a 40-year high. As the Fed raises its federal funds rate, borrowing costs rise, whether directly or in indirect ways. This should slow down the demand for goods and services and reduce inflation. Here is how the rate increases will impact different types of borrowing. Credit cards. The rates of short-term borrowing, especially on credit cards, will rise quickly. Most credit cards have variable rates, which means that your APR will rise in a billing cycle. Rate increases, no matter how small, are not good news for people with lots of credit card debt. So try to reduce any credit card debt you may have. If that's not something you can do, try to lower your rate or find a credit card that has a lower rate than the one you currently have. Student loans. The federal student loan rates are fixed so that most current borrowers won't be affected by an increase in interest rates. Private loans, however, may have fixed rates or variable rates. This means that borrowers who borrow more money will pay more interest. The new federal loan borrowers, however, will be impacted when their new loans are priced. Auto loans. Auto loans are usually fixed, so your current rate won't increase. While the Fed's interest rate moves can affect car loans, other factors have a greater impact on the rate that borrowers pay. The prices of new and used cars have risen so dramatically in the last year that interest rates might seem an afterthought. These rates are expected to increase. Mortgages. The economy and inflation have already caused long-term fixed mortgage rates to edge higher. Homeowners with adjustable rate mortgages and home equity lines will be affected more than those without. Most ARMs are adjusted once per year, while a home equity line or HELOC adjusts immediately. The federal funds rate doesn't directly affect mortgage rates. Instead, they track the yield of the 10-year Treasury bond. This is affected by many factors, including investors' expectations on how the Fed will react to inflation and such. Inflation has already caused mortgage rates to rise, even though they still are historically very low. Savings accounts, CDs, and more. You may have money in bank accounts. However, whether rates rise or relate to higher yields depends on which type of account you have. A Fed benchmark increase often means that banks will pay higher interest rates on deposits, but not always immediately. Even so, rates remain quite low. However, the inflation rate is likely higher than any of these rates, so money in bank savings accounts loses its purchasing power over time. So be aware that interest rates are increasing, and be prepared to properly manage your finances with the higher cost of borrowing.